We are back on Halftime. Ares Management holding its annual Investor Day today. Our own Leslie Picker is there and joins us now with a halftime exclusive. Leslie?
Scott, thank you. Yes, I am here with Tony Ressler and Michael Arougheti, the executive chairman and CEO, both co-founders of Ares Management. And it's a big day for you all. This is the 10-year anniversary since your IPO. We're here for your Investor Day. Over that time, in the decade since you went public, Ares stock has grown 650%. Tony, I want to start with you. As you take a step back, how would you characterize the firm's history in a way that informs where you're going from here?
Well, again, we look at the 10-year history of being a public company, maybe 25 years as being a company at Ares Management. And we've had a long and remarkable road, but the past 10 years, I don't mean to sound completely confused by it, but please understand, I did not expect that our market cap would go up 10 times over the past 10 years. I didn't think our FRE or operating income would go up 10 times over the past 10 years. I didn't think our assets under management would grow 5, 6, 7 times. What I did think is we were a really good company when we went public, and I thought we had an ability to be great. And you know, that combination of the markets that really did come our way and our ability to focus on both credit and origination and finding quality people, all of the things that we've been able to do over the past 25 years has really built upon itself. And I must say, I'm so proud, so delighted about where we are. I don't know if I'm surprised or just excited and
it's
proud.
Okay to be both.
But I must say, it is a really, really good company that we have a lot to be proud of.
And Mike, you all set targets today, 5-year targets, in fact. You said you expect to grow AUM organically, not through M&A, to $750 billion by 2028. That represents a CAGR of more than 12%. Do these targets still hold if there's a recession or some sort of black swan event? And I ask this because a 5-year target is a pretty long way into the future.
Yeah, the fact that we're actually willing to project out 5 years, I think, says something about the conviction that we have on the results. What's interesting about the forecast we put out, we did put out a $750 billion AUM target, but I think as importantly, we said that we would grow our distributable income 20 to 25% and our dividend 20% plus. And the reason we have conviction, to your question, is the business is designed to perform in any market environment. And in fact, if you look at our history, the 2 times where we've grown the fastest were during the GFC and during COVID. So there's a lot to the structure of this business in terms of how people give us capital and how we invest that gives us that confidence that we're going to be able to navigate whatever's in front of us.
Now, I want to follow up on that because we were at the JP Morgan Investor Day yesterday, and Chairman and CEO Jamie Dimon, he spoke about private credit, and he said, quote, "A lot of those folks who took private credit loans will be stranded when the you know what hits the fan because they can't roll over a loan at 14%. Their company won't be able to afford it." He said banks work with borrowers in a crisis, but in the, quote, mark-to-market world of private credit, they have to, as a fiduciary, book it at par. So he says basically private credit hasn't dealt with high interest rates, hasn't dealt with the recession, and it hasn't dealt with high spreads. What's your response to that?
False. Look, we've been investing in the private credit markets for 30 years. A loan is a loan, whether it's held on a bank balance sheet or held in a private credit fund. Private credit funds are largely unlevered. Banks are 10 to 15 times levered. Private credit funds are equitized by long duration capital from institutional investors. Banks are equitized with short-term deposits. So I think there's fundamentally structural differences that change behavior. If you look at Ares, and we talked a lot about the strength of our credit performance, we've invested $150 billion into the private credit markets since we founded the firm, and we had a loss rate of 1 basis point. So everything that we've seen over the last 30 years would indicate that the risk that people are trying to argue exists in our market just isn't true.
And given, Tony, that you all invest in 3,200 portfolio companies and investments, most of which are out of the public eye, what are you seeing on the ground as it pertains to the potential for a recession, as it pertains to inflation, as it pertains to consumer spending? And do you think those largely private investments mirror what we're seeing in terms of public commentary from public CEOs, Fed officials, and the like?
Well, generally speaking, I think what we see in our portfolio are companies generating positive cash flow growth. So we're seeing a really decent economy out there across the portfolio. But back to the original point of where private credit was and where it's going, really since over the past 30 years, but really since the GFC, assets have moved off the balance sheet of banks, which are generally short-term liabilities that maybe shouldn't be that much of an investor in long-term assets. And they've moved off the balance sheet of banks onto long-term investors, onto the balance sheets of firms like Ares and our investor base. And ultimately, this marketplace is growing even bigger than people appreciate. It's growing in the US, it's growing in Europe, it's growing in Asia, it's growing in corporate assets, it's growing in real estate assets, it's growing in infrastructure assets, it's growing in asset-backed security. So generally speaking, this world of private credit, irrespective of what some folks might want or wish or hope for, this asset class is even bigger than people appreciate today and is going to get far bigger over the next 5, 10, 15 years, and for good reasons, and for reasons that will actually reduce systemic risk, because these assets are going on to the balance sheet of assets of companies that are not highly levered and that do not finance themselves with short-term liabilities or customer deposits. So again, this all makes perfect sense since the GFC, as you highlighted the difficulties in certain types of financial institutions investing in long-term assets.
Although some would say that leverage in the system, comprises the NAV loans that are out there, net asset value loans, and other interconnectivities with the banking system who are providing some of the financing and so forth. You still don't see a systemic risk from the broader system as well?
There are bad actors in every asset class, and there are people that utilize too much leverage in virtually every asset class. But generally speaking, Ares Management is an unlevered manager, modestly levered, and doesn't require customer deposits or insurance. Large banks are generally 10, 12 times leverage with customer deposits, with government insurance, that have a different level of risk and therefore should have a different level or different type of balance sheet and investment base, and they do and should.
Mike, what do you make of the retail strategy as well as a huge component of your growth strategy? You say in today's presentation that people with $1 million or more in investable assets, they comprise about 3% of alternative asset penetration, and you think that will grow to 6% in 2028. How does all of this factor into kind of that growth strategy surrounding retail, especially as it grows? It will likely get more attention from regulators as well.
Yeah, I think, look, what we've tried to build at Ares is a diversified capital base and a diversified growth engine. So when you look at the funds that we manage liquid traded funds, we manage semi-liquid non-traded funds, institutional funds, et cetera, et cetera. I think the rise of retail is an important megatrend because what it does is it now gives access to everyday investors, access to alternatives that used to only be the purview of institutions. So this idea of the democratization of alternatives is really important, right? There's been a meaningful shift in people's ability to support their retirement as the population ages. So not surprisingly, they're finding their way to these types of structures. At the end of the day, what's going to tamp growth in this industry, or at least moderate it, is are there enough quality assets that we all can originate and structure to deliver outcomes to the investor? So we're incredibly enthusiastic for the growth in retail, and you saw the projections, but mind you, that's growing to some extent, at the expense of our institutional franchise as we diversify. So I think you have to look at it in the context of the broader market growth rate and not just isolated to retail.
No, and why would retail be any different, if you will, from endowments or foundations or pension funds or sovereigns? Some might have 30, 40, 50% in alternatives. Retail, we're arguing, would be 3% going to 6, 7, 8, maybe 10% over the next several years. I think a pretty reasonable assumption.
I believe my colleague Scott Wapner has a question for you both in studio.
Thanks, Leslie. Hi, gentlemen. It's great to have you on our program. I've been thinking a lot about sports as an investable asset. Michael, obviously, congratulations to you on the Orioles. You're now one of the owners.
Thanks,
and Tony,
Scott.
For our viewers who don't know, you own the Atlanta Hawks of the NBA. You know, as I ask you this question, the NFL is actively considering, and they will this week in their meetings in Nashville, decide whether private equity can be investors in their teams. And Tony, I'm wondering how you think about that as a possible opportunity for Ares.
Well, I think there's no doubt that the NFL, I hope, is a real possibility for Ares and for our sports and media funds. And for what it's worth, sports generally speaking, the media and sports world is a much larger asset class, Scott, that people really appreciate. I mean, this is hundreds of billions of dollars of not just value and, frankly, lendable assets, but the ancillary assets, the stadiums, the arenas, the real estate developments, ancillary businesses. These are all huge opportunities that private equity and private credit will undoubtedly be a meaningful part of. I would also suggest that the other relevance is that the sports world, as people appreciate global media rights and the value of these franchises and the importance and value of the overall assets themselves, will dramatically push to improve management and expertise in these businesses, which really historically haven't always been very well run. And you're seeing a massive transition over the last 10 years, and I would argue over the next 10 years, to far more professional management and really improve margins and operations and actually revenue sources. So that's all part of the game, I think.
Mike, how do you think PE firms would view being passive investors? I mean, it's just not something you guys normally, that's not how you roll, right? You guys like to have a say in the operations of the kind of business that you invest in. In this case, certainly in the NFL's case, you could only be a passive investor.
I'll say two things. One, we're in the business of delivering investment outcomes to investors. And so given our capability and track record in sports investment, both professionally and personally, just granting access, I think, is a huge value proposition to the investors. But I'd also encourage you to think about what we've been able to do in our credit business, where we're not a control investor, but we have significant influence over the portfolios, where we can give them access to best practices that we see that they otherwise couldn't. So my hope and expectation would be that if we were involved in this effort going forward, through our skill set, we would be able to deliver some of this expertise and track record that Tony's talking about, just in terms of engagement and influence without necessarily having control.
Yeah, Tony, how would you think about
making businesses? Oh,
go ahead, please.
Go on. I'm sorry.
No. You finish your thought, and then I'll ask you.
No, I was just adding to Mike's point that making businesses run better is what alternative asset managers, what private equity folks, what private lenders, what they try to do with or without control. And I think many of the leagues will appreciate that.
How would you think about sort of your return on investment, though, and potential exits? You, Tony, may want to realize your gain or return faster than would be typical, per se, in the NFL. How would you think about that?
Well, again, I think what the NBA has already introduced, and certainly the MLB and the NFL are moving towards, is you have private equity investors already buying minority pieces of teams. So I think what you'll find, an increasing number of institutional investors and frankly, an increasing market in minority investments for franchises in virtually all of the major sports leagues. And that, of course, creates a bigger market, and there'll be far more liquidity for both control and non-control owners as a result. Better investment environment.
Yeah, I would liken it, Scott, to just the growth that we're seeing generally in the secondaries market, right, where a whole ecosystem of capital solutions is beginning to form to grant liquidity to investors in illiquid assets or owners of illiquid assets. And I would expect the sports landscape to develop on a similar path.
I appreciate it.
Wonderful. Well, thank you both. Thank you both so much for being here today. Tony
Ressler,
for
joining us.
Mike Arougheti at your Investor Day.
Thank you.
Thanks for having us.
We look forward to following your progress. Appreciate it.
Thank you.